Welcome. This presentation is the Massachusetts Department of Revenue's Division Local Services latest installment on a series about revenue and expenditure forecasting. My name is Melinda Ordway, and I'm a member of the Financial Management Resource Bureau, formerly known as the Technical Assistance Bureau. Just a note, please be advised that today's presentation is being recorded. And if you have any questions, please type them into the chat and every effort will be made to answer them at the end. Following this presentation, participants will receive an email that will contain this presentation and a link to the video. Forecast materials and other tools are found on DLS's website, located mainly in the Municipal Finance Training and Resource Center section. Once in the center, under Municipal Finance Tools and Templates, you will find DLS's forecast templates and an instruction manual that may be used to create your own forecast. We also provide a debt service calculator that is provided to guide communities in projecting debt service. And we've developed a capital template tool. It is designed to help local officials monitor capital spending goals and providing an easy means to track annual and projected spending on maintenance, equipment, and infrastructure. For municipal best practices, which we refer to often throughout this presentation, these are located in two areas. In the Training Resource Center, there's a municipal best practice section that you will find documents and videos on budgeting, financial indicators, and other resourceful topics. In addition, under the Financial Management Resource Bureau, you can find policy reports prepared for specific communities. We encourage you to read through a few, comparing them to your own formal policies, and possibly identify policies that you may not have, or greater detail you might want to consider incorporating into yours. And last but not least, we encourage you to visit DLS's YouTube channel. There you will find the first 3 forecasting segments, along with a variety of topics we've published for local officials to view on their own. The Division of Local Services first 3 presentations focused on developing a forecast that involves a collaborative effort and input from among the financial officers and policymakers, as well as various viewpoints and expertise from other officials and boards. It requires local officials to regularly review current data and identify revenue expenditures, trends that may have immediate or long-term influences on your policies, revenue cycles, and your community services. They should adhere to state statutes and guidelines. Examples, Prop 2.5, developing new growth, education reform requirements. And it follows your financial policies and incorporates best practices. And when developing and documenting realistic financial forecast assumptions. It serves as an essential planning and policy-making tool that reasonably projects revenues and expenditures. It doesn't balance them. That's what a budget does. It is done over a multi-year period that helps assess the current fiscal position, puts future funding decisions into context, and promotes a forward-looking budget process, which helps you hopefully avert deficits, achieve long-term fiscal health, and strategize on capital investments and community development. And ultimately, it will help guide the annual budget process. By presenting various scenarios based on different assumptions, officials can evaluate the impact of budget choices. Upon the conclusion of a successful, balanced budget being adopted, the forecast is updated to reflect the community's actions, and monitoring and data trends continue. Now, before I proceed, I want to summarize building the forecast covered in the first 3 presentations. Forecasting begins with identifying the community's resources. Revenues. All communities have 4 major revenues. Their property taxes, also referred to as the tax levy, state aid, estimated receipts such as excises and charges for services, other available funds, which include free cash, reserve funds, and other special revenues. As a matter of practice, hint, recurring revenues should be used for recurring expenditures, most notably the budget. It is not advisable to use non-recurring revenues such as free cash and stabilization to support ongoing expenses because there's no guarantee they'll materialize annually, and making balancing the budget even harder when they significantly decline. So that's why we encourage use of stabilization and free cash to balance or used in the forecast for projection purposes is not a wise decision. Some communities have also adopted local option sources. Those include the revenue, the Community Preservation Fund, and the Enterprise Fund. Generally, these optional revenues are self-supporting, so the expenditures are based on the available revenues. Once a revenue forecast is constructed, local officials then compile data on their community's expenditures and continuing costs of operating at a base level of services. They include your employee benefits like life insurance, pension, and other post-employment benefits. Risk management, such as your property and vehicle insurances, public safety insured in the line of duty, as well as workers' compensation. Debt service is also included and constructed from the repayment schedules provided to the community. State assessments for charges for participating in specific state and regional programs, and then department budgets, both community and educational. And that together, these comprise the operating budget. The projection methodology used impacts the forecast outcome. For revenues, a conservative approach, which we typically recommend, knowingly underestimate, but it's intended to build in contingencies in the event there are unforeseen circumstances, while more accurate or aggressive revenue estimates could run the risk of shortfalls. Remember, when reviewing your trends, be cognizant of different recessions and the effects they've had on your community during the 1980s, the 1990s, the 2000s, and the most recent Great Recession. The impact on revenues and challenges in preparing a balanced budget, or worse, having to make mid-year cuts and layoffs. It's easier to add additional revenue for expenditures within reason, rather than having to claw back expenditures due to revenue shortfalls. For expenditures, we generally look at 3 different models that can be used. A maintenance or level service budget projects the costs needed to maintain the current level of staffing and a mixture of services into the future. A level funded budget appropriates the same amount of money to each of the departments as it did the prior year. This would represent a budget cut if there are increases in mandated costs and other fixed expenses that must be funded. And the last is to adjust expenditures by a specified percentage increase or decrease, either across the board or by department. Ultimately, the forecast must quantify the impacts of locally adopted policies, including your spending priorities, maintaining certain levels of debt service, capital spending levels by integrating the community's capital improvement plan, as well as budgetary effects of maintaining reserves, such as stabilization and free cash. The resulting forecast generally falls into one of 2 groups. For some, projected revenues are greater than expenditures. This provides opportunities to fund additional requests, address more capital needs, or make transfers to reserves, setting aside funds for a later time. For others, projected revenues are less than expenditures, and this commonly is referred to as your funding gap. It indicates that the community will need to review revenue estimates, seek additional recurring revenue sources, or reduce spending during the annual budget process to bring this into balance. Depending on the size of the gap, this can be a very difficult situation to address. Once the budget is adopted and the base year of the forecast is balanced, the forecast is then updated. Having completed the forecast, it should not be set aside until the next budget cycle, because the forecast is a living document. It needs to be updated as information becomes available, and it provides a platform to further analyze your revenues and expenditures, to begin looking at issues the community is facing in the near and the long term, It also allows the opportunity to explore by proposing what if. Now, let's begin with the revenues. During the normal course of the fiscal year, all revenues should be periodically reviewed to ensure that collections are heading in the right direction to meet or hopefully exceed budgeted figures. To do this, it is necessary for the accounting office to report revenues on a regular basis. We suggest monthly. This requires the treasurer to timely process turnovers, reconcile activity, and transmit to the accounting for posting. If you're not receiving revenue reports, it's going to be very, very difficult to do meaningful forecasting. Based on the revenue reports and the data and circumstances that the community is experiencing, it may be necessary to further look at your revenue sources and maybe do some additional analysis. It's useful to monitor these collections, identifying both positive and negative trends. One example is motor vehicle excise. Motor vehicle excise is $25 per thousand. The excise is based on the manufacturer's list price for vehicles of the same make, type, model, and year of manufacture. It's calculated by applying the set state percentages, the highest being 90% for the model year, and it declines each year until it reaches 10% of the list price in the fifth year. The percentage remains at the 10% for all succeeding years for the life of the vehicle. As new and more expensive models are released and hopefully purchased, the community could potentially see an increase in the motor vehicle excise. However, economic downturns may impact the new car sales so that folks hold on to their vehicles longer, and it may be an impact on the amount of excise bills until there's a recovery. During the recent pandemic, microchip manufacturing was disrupted and fewer new vehicles were produced, resulting in less first-year model excise being issued. However, there have been reports that used car sales have increased and the number of vehicles principally garaged in communities could have increased also, which would increase the number of bills issued and help potentially increase your motor vehicle estimate. The community's administration should meet with the assessors and the collectors to review the assessment data and any billing and collection impacts on the community. Just as a reminder, though, motor vehicle excise formula is based on the manufacturer's list price, not the retail price. Just because people may have been paying premium prices for new and used cars, it does not impact the motor vehicle calculation for each vehicle. Another area worth reviewing is building permits. Now, with building permits, it's your community's approval to allow construction, addition, and renovations to a property. And it's intended to make sure that the work complies with your land use, zoning, and construction standards and codes. The types and number of permits may vary over time, so local officials could collectively review the permit information, identifying trends as well as unique situations. Remember, a plot that's subdivided and a new buildable lot gets a building permit for a home is different from a tract of land that's approved for a multi-parcel residential development. And both are different from a commercial site getting either a construction or expansion permit. Economic impacts of permit timelines should also be examined. In good economic times, there may be greater numbers of new construction starts and remodeling projects. Whereas in less fortunate times, projects could get delayed, take longer from start to finish, or be scrapped entirely due to a lack of or high cost of financing. It should also be noted that building permits translate into new growth and expanding the tax base. As with all revenue, receiving timely information is key to forecasting. The assessors should be receiving updates from the building department on permits, inspection schedules, as well as certification of occupancy, so they can schedule their own inspections to make sure they're captured in the new growth for the subsequent fiscal year. Routinely, administration should have discussions with a team of officials involved in the community and economic development. These should include, but not limited to, planning, conservation, building and inspection services, and the assessors regarding plans and permits, both historically as well as prospectively. This would be useful in projecting building permit fees, and it will have a ripple effect into the new growth on the tax levy for the forecast. In addition, depending upon the type and number of permits issued and executed, it could have an effect on the level and amount of services as well as departmental budget projections. Now let's explore the expenditure side of the forecast. An important area to consider is service contracts. For some services, a third party is contracted to perform work for a price. As such, officials should be familiar with the contract terms so that management monitors the supplier's performance, ensures costs are within budget, and takes actions if there are any issues. General law limits the length of any contract to 3 years. So be aware of potential cost increases on subsequent contracts. Officials should consider potential factors that may positively or negatively impact the renewal costs. Is the service area increasing or decreasing? Is there adequate competition, or are suppliers entering or leaving the marketplace? One example is solid waste and recycling, an essential part of public and environmental health that requires proper collection, treatment, and disposal. Whether a community operates a transfer station or provides curbside collection, both have hauling and disposal costs, which may have labor cost increases, higher fuel, insurance expenses, and require expensive replacement equipment. Federal and state regulations governing solid waste disposal may also have factors, including truck emissions, landfill permitting, and hazardous waste disposal. Recycling initiatives over the years, separating your glass and plastic, cans, paper products, as well as most recently composting organic waste for resale and reuse rather than being sent to your landfills or incinerators, has been helping to reduce the cost. However, in recent years, recycling efforts have run into challenges. There's confusion on how and what materials are recyclable. Confusion often leads to placing recyclables in the trash and trash in the recycling bins. Prime candidates are the soiled pizza box and the disposable coffee cup, both of which are not recyclable. Historically, some of the recycled materials have been exported out worldwide. However, changing international policy have limited the export of these materials. In the absence of a strong domestic market for recyclables, it could be sold and repurposed affordably. Communities may be faced with difficult decisions. Because recycling costs are skyrocketing, some communities have stopped recycling and moved entirely to trash disposal. Other communities are exploring pay-as-you-throw or annual assessments for residents to offset the solid waste cost. Considering all factors, officials would use the forecast to play out various scenarios that the community may be facing and begin planning to reach the best outcome. The last topic of this presentation is the topic of projecting personnel costs. In the forecast, the personnel costs, which include your salaries, wages, and other compensation types, such as overtime, stipends, longevity, are included and should tie to the community's existing collective bargaining agreements, individual performance contracts, or compensation schedules for non-union employees. To be clear, the forecast should only include contractual cost increases, salary step increases, and other known obligations in the departmental section of the forecast. When the contract or compensation schedule reaches the end of the agreed upon term, for example, fiscal 20 to 22, then only the applicable step increases in longevity, those items that are more tied to years of service are included in the departmental section. This is important because the purpose of the forecast is to help you determine the available revenues to fund new costs, such as raises and collective bargaining agreements. A helpful way to help manage personnel costs for all employees is to construct what we refer to as a position control table. It should be organized by department and include each employee, their position, the affiliated contractor otherwise noted as non-union, elected, or if it's a stipend payment. Additional useful information would be if it's full-time or what percentage of FTE, hiring anniversary dates, as well as longevity dates if applicable, and educational incentive pay, especially if it's tied to the base salary. It should begin with the budget year, noting the current grade and step information associated with salary or wage budgeted for the year. And it should be on the 52.2 week basis. For each of the succeeding years of the forecast, salary wages are projected on known factors such as contractual and step increases. Other compensation types should be included so that the gross personnel costs in the spreadsheet will reconcile with the current budget year figures. While this table is intended to enhance the forecast, it can also be very useful when developing departmental budget projections going forward, as well as costing potential labor contract settlements. Now, a well-formulated forecast also allows for the impact of future wage increases to be clearly demonstrated in a standalone cost of living adjustment COLA table. The COLA table should be linked to the position control data. At a minimum, it would be organized by contract and compensation schedules, and the reader would be able to see the total compensation subject to increase. When calculating the future financial impact, the percentage increase is applied to the compensation identified in the first year. For each subsequent year, the prior year's financial impact is combined with the forecasted compensation before applying the new percentage increase. The COLA table will give officials a cumulative financial estimated impact of today's decision into the future. In closing, there's some key takeaways to remember when your community is developing the forecast and when moving forward to explore what-if scenarios. We cannot stress enough, all members of the financial team should be involved, and other officials and boards should provide input and expertise to help develop the forecast. Current data is required. If it's not available, determine what needs to be done. Just a side note, ongoing lack of current data may be indicative of other issues that need to be addressed within the financial team. Officials should be reviewing this data and identifying trends that may have immediate or long-term impacts on the policies that govern how this forecast has been developed. Policies should be reviewed and updated as needed. As a living document, it is essential to continually update the forecast as information becomes available, similar to your budget year. Forecasting promotes forward-thinking budget processes that help communities hopefully avert deficits, achieve long-term fiscal health, and strategize on capital investment and community development. Finance officials should be briefing the policymakers on the forecast periodically to keep them informed and present analyses conducted so they're aware of potential impacts that could positively or negatively impact the community. The forecast serves as a planning tool. It helps the policymakers assess the current fiscal position. It puts future funding decisions into context and should assist in developing reasonable budget options in the best interest of the community. I want to thank you for attending this presentation. As noted at the beginning, Forecast materials and other tools in the video may be found on our website, so please visit mass.gov/DLS.
Melinda, thank you so much for presenting this morning. Before we open it up to questions, a few folks have let us know that the audio has been just a tad bit in and out. I think everyone was able to hear for the most part what you said, but we may ask that you answer some of the questions about maybe what was heard and what was not heard, maybe a few words missed here or there. But with that said, we do have one question that we have received. I just missed it here. Okay. So when you speak of trends, do you mean historic data? And maybe, Melinda, if you wouldn't mind talking about some of the data that's available publicly that would be easy to pull quickly, available on DLS's website as well.
In looking at your actual data, either using your direct data from your budget to actual reports, that's helpful. We also have, if you want to do comparison against other communities through our database on our website is helpful. To looking at that is in terms of the trends, seeing, are there constant increases? Are, ebbs and flows with different things on the revenue side? And again, working with the departments as to identify, was there a reason for such factors? Looking at average increases is helpful, but again, being conservative with your revenue estimates will help you. And again, the point of the forecast is not to balance every single year. It's to just project if we have a 1%, if we have a 2% increase in this revenue source versus that one. Seeing the implication in terms of what you would potentially be looking at against what you're projecting on your expenses. You should be able to, work with your team and identify any trends that you may be looking at. On the expenditure side, again, not everything is programmatic from year to year. I think you've all experienced that as a local official. Things pop up. It may be a one-time expense, or maybe a new expense, or some sort of revision happens in a department, so there's a cost savings. Being able to identify any of those changes that may have affected it, that created impacts on the historical data, that should be noted in terms of possibly, focusing more closely on factors, looking for trends going forward. We did have a few questions that were initially sent. I believe many of them have been answered with the references to the materials. There was a question about.
Melinda, sorry to interrupt you again, but as long as we're talking about historic data, is there a number of years that folks should be looking at in terms of historical data?
That's their choice. Again, it's helpful to look back at it. It may be a long way, but knowing, how things happened or what were the impacts locally during the different recessions. Yes, it was more than 10 years ago, but especially with the most recent recession, the fact that it took, the initial hits were required often the use of the non-recurring revenues to help communities just, how shall I say, keep their heads above water. But just looking at how they recovered and the decisions that were used can be helpful. Typically, when we will put together a forecast for a community, we will only look at the most recent, 3 to 4 years, along with the budget year that they're currently in, as a stepping off point for the forecast. But again, we're trying to develop the tool for the community then to use on their own. Again, it's not something that's published and put on the shelf. It should be actively used, preferably by one person actually running the controls of the forecast so that you don't end up in a really awkward situation where there are multiple versions running in a community.
And aside from DLS, do you have any other suggested websites or other sources to gather the sort of local economic trends that might be able to help folks with their forecasting?
In terms of, if you want to, when looking at the data and comparing yourself to other communities, sometimes looking at whatever financial information they have may be useful. Again, I cannot emphasize enough in terms of best practice to having formal policies that provide input as to how things were designed or what things were considered. Remember, the forecast is not the budget. It's a framework that you're basically throwing in a lot of assumptions and seeing what's the possible play out. And that the goal of the forecast is to pull it into balance in order to have a new base year. One of the other websites that we use quite a bit because it has such an impact is the DESE website in terms of Chapter 70, net school spending requirements, choice and charter numbers. You know, one of the questions we did receive at the beginning with the registration was, you know, how do people decide, you know, how to share the money between, you know, educational and non-educational activities? Well, at a minimum, communities must meet the minimum requirements set by ed reform, which are annually issued with the governor's budget. It's a starting point. It then goes through the state budget process, and that the eventual or the final outcome, once the state budget is adopted, from beginning to the initial governor's numbers and the final, there may be changes, either in terms of the amount of aid, which will ripple through everybody's calculation, but sometimes because of changing numbers with participants in the choice and charter programs, that could also, as well as, you know, attendance to regional districts, numbers amongst members in districts will change. And so that some communities will see different minimums or net school spending requirements. Monitoring that, keeping an eye on that, working with the school business office so that there aren't any blindsided costs that come out of nowhere. More and more communities, not only do they have budget policies, but sometimes they actually get into the details of revenue sharing, where if you are projecting new revenue for a particular year, noting that, you know, at a minimum, you take out your fixed obligations and debt service costs off the top, and what's left, there is either some sort of formula or an agreed upon percentage as to how much is being allocated to education purposes versus non-educational purposes in the community. And that presenting that in terms of the forecast as well as the budget, it puts everybody in the community on notice that, you know, this can't be a runaway. We need to agree that there are limited resources that are available, and that we're not intending to go to the nth degree in projecting or budgeting actual figures based on the prior year, because it would potentially impact your free cash calculation in subsequent years. And nobody wants to be left without a nice solid reserve. In your personal life, you don't want to be living paycheck to paycheck, and you don't want the community to be doing the same. Planning to, as a part of the forecast, building up those reserves for particular purposes, preferably one time or pay down of debt service. But again, you know, our numbers, comparable communities, what they're doing, as well as the DESE website, are really good links to look at in terms of getting other information.
Thank you. Another couple of questions, if you don't mind. So one about trending and using conservative estimates in the forecast. So the example here is about excise tax. So if the excise trends were to be used in, when forecasting excise in past years, if it typically goes up each year by 5%, what would you use for the next year's excise tax revenue value? Would you use the same value as last year's actual in order to be conservative? Or would you keep using the 5% figure that has been seen in recent years?
Seeing that we just had the situation, I would, do a deeper dive into the 20 data as well as the 21. Because 20, hopefully people, the numbers were pretty much there. There were some new vehicles purchased. Look at especially the 21 data with the reports of more used cars, more cars getting on the road, so that the assessors and the collector will help give insight as to the vehicles, the number of vehicles on the road, and what was actually billed. And then you actually should be looking at what's being collected and what's outstanding, so that would give a little bit of insight, because I think there will be a bit of a tweak there in terms of the numbers. The 5% growth, it's possible, but again, when projecting local receipts, if you're looking at your actual collections as a base, I wouldn't try and get too close to that. A nice conservative would be 90% max of that number. It's better to give yourself a cushion area in case something happens, and you could bill it all, but it may not all get collected. And that's why when projecting, doing a 5% increase for the duration of a forecast could be it could be very aggressive. And I think that it will create a gap that, you can close in the budget process, but the point is, at what cost? Do you end up building up such an expenditure in terms of departmental budgets that you're now pushing the revenues at the budget process to meet them? Or are you then have to change course and make cuts, which can be difficult to do.
Understood. Okay, thank you. Another question about inflation. Do you see or recommend cities and towns building inflation into their forecasts around expenditure levels?
In terms of the salary and wage information that was discussed in the position control and whatever contracts are around there, if you're adding positions, that's going to be a whole different subject. That's based on the availability of resources. In terms of general expenses, you should be looking at, any cost increases that they're currently being absorbed. Have paper costs gone up? And if you need to, not using one across the board expenditure increase of inflation, you could do 2%, you could do 3%, looking at individual areas. Solid waste, contractually, it could be at a different percentage. Different materials in the public works department for maintenance of roads or ice and snow purposes, looking at those costs in terms of how much was it last year versus this year. Ambulance service, have the products to be replaced or the amount of products that had to be purchased to support an ambulance. Looking at that, looking at regional assessments for whether it be the state aid assessments, or looking at regional schools, or if they've got some sort of regional dog officer or veteran service, looking at those expenses and knowing what's going on. Again, it's helpful in these circumstances when you're on a regional basis to make sure that there are periodic meetings of the communities that participate in it, either through side table conversations or actively run by regions. I'm familiar with a couple of regional school departments that have already held, opening meetings of, this is what we're looking at for the fiscal 23 budget. And, we're trying to keep cost down, which is always a nice thing to hear. But again, being informative, making sure people participate and understand where the numbers are coming from or things that are on the horizon. So everybody can start preparing for it, whether it be operational or capital.
Another question about school enrollment and a little bit of the data that you mentioned earlier, Melinda. This question is, what steps can be used to assess declining school enrollment on annual school expenditures?
Well, typically your school enrollment is going to, it has implications on your minimum requirements or your net school spending. But again, looking at the DESE data information, you'll have, especially through the end of year reports, which I really encourage communities to be familiar with and work with your school departments to sit down and understand the data that's put into them, either on an actual basis. So the most recent report that's being put in is the end of year report for fiscal 21. And that includes actual data, and it's a number of 1920 schedules now. But then there's also prospectively the budget for 22s in there, and understanding, while you may have budgeted, say, $30 million for the school department, transportation and certain capital costs do not qualify in terms of meeting net school spending or the minimum, and that what gets reported could be a lesser figure. But when you look at what the minimum amount a community must budget for either its local district or as a member of its various regions, the operating assessment will generally be higher. And it's higher because of capital or debt service assessments, transportation, but then you've got other, which is the district knowingly is operating above what your minimum requirement is, and looking at how much that is helpful. And that understand that while your enrollment may be declining, the operational costs will still be continuing, and that it won't necessarily, it could decline from year to year, your assessment, probably not. But to be able to look at the numbers that are being included. I think the biggest impact is going to be those regional agreements or regional groups, where if a large enrollment community gains or loses a handful, it's not as large an impact as to the smaller member who may add or subtract one student. Knowing how that region operates and everybody's ability to pay is a conversation that should be going on, both internally as with the members.
Question about capital expenditures, Melinda. Should the forecast have a line item for capital expenditures within the expenses area? And I believe that's speaking to that part of the area of the template.
Right. In the template, we do differentiate. You will have capital expenditures. And again, this will start with the policy for the community. What is your definition of capital? Quite often you have smaller items that need to be regularly replaced, and that they may fall below the threshold set by the community. If those have to be regularly replaced, quite often that is budgeted within the departmental budget, because it's part of the means for their regular service. Larger items hopefully have been developed in a capital plan, and that capital plan should be a separate table that is integrated into the forecast, so that if you have an expectation to either issue so much debt every year to accomplish those, or you're using your one-time revenues to offset that or to support that, that would tie in also. most notably, say in the enterprise funds, whether you have a water, sewer, or solid waste operation, for examples. If part of that budget would be your salary and wages, your expenses, preferably, they are picking up a portion or their portion of indirect costs that are supported through the community, whether it be insurances or health or life, and indirect costs. And that if they are acquiring, or say an I&I study, and they want to support that through an appropriation that will be expended over a period of time, using retained earnings that have been certified can be used at that point. That would show those one-time revenues in to support that expense. On the general fund, similarly, if there is, a capital in stabilization fund that's intended to be used to support so many things on an annualized basis, either by policy that, you'll use X percentage or only down to a threshold of maintaining a balance of a certain level, those capital items would then be acknowledged in the forecast and then offset by that revenue that's being provided. Communities that have a specific process that within their budget that they annually appropriate a dollar amount and have an escalation clause to it, that's even better, because then you make sure that the maintenance and capital needs are constantly there without having to necessarily go to the market if that's what they want, are hoping not to do, or just to generally save. Keeping, the good balances to address those issues, as well as, keeping assets on hand so that the markets, see you favorably, and that the rating agencies also give you a support in terms of either improving or maintaining your credit worthiness, is constantly at issue. So again, some things are going to be automatically in the department because they're just routinely replaced. Others should be a matter of your capital plan, and then using the option to provide in the forecast methods of funding those, either through the issuance of debt or the use of the one-time revenues, or building it specifically into the operating recurring revenues.
Okay. I think earlier, just as the Q&A was starting, the audio was in and out for just a couple folks. Would you mind just giving a quick recap of the answer you provided previously about the number of years that the number of historical data years should be considered when developing the forecast, and what data is available to folks online?
Sure. In our template, we do the revenue forecast back to 2006 for a couple of reasons. We do it because of demonstrating the levy growth over the years. And we also then provide for the calculation of 3, 5, and 10-year averages of revenue versus commercial versus personal property growth, tax levy dollar growth, for purposes of informing the user. It also has your state aid numbers in there, your local receipts, the available funds. We're relying on the B2 form that the accounting officer prepares to supplement the tax recap, but we don't necessarily have the uses of free cash. We could probably, if we're able to find information through your online minutes or annual reports, that's helpful. But the community, and it should be able to look at their revenues as far back as 2006, because our template is designed to reconcile with the tax recap, how much was raised in a particular year. In terms of expenses, we typically look at 3 to 4 years of historical data and then the current budget, but a community might want to look further back, especially if changes in service have happened. Say a new department was organized, or separate departments were consolidated into a combined department, like Public Works Department. being able to understand, how much that cost was separately and what cost savings or what new expense there may have been with the combination as a stepping off point is helpful. But that's a local decision, how far back you want to look at the expenses.
Great. Okay. I didn't want to mean to cut you off earlier, but if there were questions that you wanted to get into that were asked previously.
Well, I think that most of them, I'm hoping that most of them were a function of looking for tools or links for information. One was about looking at combining, how school portions of the budget are being considered. And I think it's a combination of trend analysis and the net school spending requirements, changes in population served in their needs, and competing charter and choice options. But again, more and more communities are adopting budget policies or revenue sharing policies so that they knowingly will look at, if we're projecting new revenue over the course of the forecast, the first thing we're going to do is either pull out the non-recurring, the fixed costs, obligations, and debt service costs that need to be funded, and that any new revenue, looking at that as a way to, locally deciding how that will be split or how a formula is derived to figure out the split of any net new revenues. But again, in the forecast, we're looking at trend increases. If a community is historically up in the school department, say, 7 to 8%, then on the forecast, it's okay, let's look at that and project it that way and figure out, how does this look in the long term? I mean, are we close? Are we really off? Does it create a substantive gap in funding? That's the point of the forecast. You play your what ifs. And that if that gap is going forward in that such a manner because of historical increases, then maybe it is time for the community to look at its budget policy or devise a revenue sharing policy. There was a question about, should the accuracy of past forecasts be considered when making a new one? And should the overall municipal account balances be considered as a part of the financial picture, or should a forecast only be looking at operating revenues and expenditures? Okay, first, the forecast isn't a matter of accuracy. It's a framework. It's not a budget. And the framework allows you to put multiple information in there and to create a series of assumptions that you're using to create a picture. And that should give you an indication if those things were to materialize, where you could end up. A 5% cost of living increase over the next 3 years for one union, seeing where the expense would go, and would you potentially have the revenues to support that? That's one of the purposes of the forecast. But it's the only accuracy is going to be the first year, and that's going to be based on a balanced budget. And again, that budget has to be closely monitored, and that as circumstances change, the community needs to be able to address them either through supplemental appropriations as necessary with available resources, or worst case scenario, having to work with departments to slow down spending if your revenue collections are not necessarily going the way you would like them. So the forecast is going to be data driven. And from our perspective, when we're looking at projections, especially in the area of local receipts, a lot of communities will tweak it going, well, if we brought in 100,000, why aren't we projecting closer to 100,000 for the forecast going forward? Again, there's no guarantee that things will be the same amount billed, or the same amount of payment activity, or interest in services. So looking at your actuals, relying on the more conservative methodology, and not really budgeting or forecasting above 90% of the prior year actual. Just to keep yourself from having to double back when it gets down to actually putting together the next forecast. Looking at the overall balances of a community, again, in our forecast, the methodology we typically use is we will not encourage, nor will we put into the forecast projected free cash balances, because free cash isn't a figure until a balance sheet is submitted and the necessary calculation is done that renders what the director of accounts certifies. So to forecast out free cash is a slippery slope. And again, it's a function of the prior year's operation. You know, given what was budgeted, did people spend to the last penny so that there are very little turnbacks? Well, that will really affect your your fund balance. And if in certain circumstances, maybe your collections aren't necessarily 99%, they dropped a bit, that also, higher receivables will impact the eventual free cash certified. So in a matter of speaking, when you're looking at the forecast, you don't want to use those reserves like stabilization funds, unless it's one-for-one for non-recurring. You don't want them for operating purposes. You don't want to build in the free cash, because it will affect the eventuality of what you'll be facing in terms of the ability to fund it, but it will also have negative impacts if things go south. And no one knows when a recession will happen. It just happens. So again, conservative is our constant theme, because we've seen way too many things. I can speak firsthand. I've worked for the Division of Local Services for almost 35 years. I've seen good, I've seen bad, I've seen, oh my goodness. I've sat on 2 control boards, and I've worked with the county sheriffs for a number of years. So conservative is better. It's easier to add when you get to the budget process. Yeah. Another question was, what projection of revenues and expenses are significant to track when we have almost no debt, no capital on the horizon, and over 90% of our revenues are made up of tax, commitment, state aid, and permits and licenses. On our expense side, almost 80% of our expenses are regional school assessments, police, fire, ambulance, highway, with no union contracts except for the schools. Well, first and foremost, all revenues and expenses should be tracked and considered when developing the forecast. It may not be a pretty picture on your first time out doing a forecast, but that's the point. Put it all out, agree upon certain assumptions you're going to use, put them into play in the forecast template, and it will give you an idea. If it creates a substantial gap in funding, start to think about areas that could be closer, looked at closer in review. The same on the expenditure side. What are the things that are triggering the expenses to increase? Sometimes it's the unavoidable costs, being your fixed costs. But in terms of debt service, what is your capital? What are the capital needs of the community? What are the conditions of everything? That has to be an honest conversation too, in terms of gathering all the data, in terms of all your structures, all your properties, their age, condition, what is the level of extraordinary maintenance that is being done, or not done. So that those have to be considered, so that hopefully you can start planning to accomplish those, either through the process of setting aside monies into reserves for the eventual use, or considering going to the market and doing some borrowing, either through State House notes or through other long-term borrowings. But it has to be the conversation. And these are the conversations that hopefully the forecast will capture possible points of interest that will then be discussed and explored. So again, every revenue and all expenses should be monitored and looked at so that people understand what are the trigger factors for each. And I hope everything else has been covered in terms of the links to all the products that we have on our website available to everyone.
All right, well, unfortunately, it is 11 o'clock and we want to be respectful of everyone's time. Linda, thank you so much for presenting today. Just a reminder to folks that the recorded version of this presentation will be available online, and all the links to that video and other resources mentioned today will be posted and sent directly to all of the registrants for today's presentation. Keep an eye out for future webinars, and we hope to see you hopefully within the next few weeks when we'll be announcing another one. If there are any questions that weren't answered today, please feel free to contact us. And Melinda, thank you again for presenting, and thank you all for joining this morning.